Everyone, welcome to Trader Talk with Disciplined Mind Trading. If you're joining us for the first time, my name is Bobby.
Steve.
And for this week, we will be continuing on going through the basics of canceling. And we will be covering the C in canceling. Big earnings, big sales.
Let's get started. So this week's podcast is about the C in canceling, big earnings and big sales. Really, to quote right out of the chapter of the book, it's current big or accelerated quarterly earnings and quarterly sales per share. So last week we did the N in canceling. This week we're doing the C. So ultimately, where do these earnings and sales come from? They're from new products, new management, new industries, and stocks that are changing the way we work, live, and play. The N in canceling and the C in canceling are basically joined at the hip. But what this gives you is the evidence of the N. So if you're not understanding what the N is, you're going to find it from the C in canceling. And this is going to give you the detective tools to figure out if you're seeing a company with big earnings and big sales, is this a company that has new products that are changing the way we work, live, and play? So how do we find these companies, and what are the qualities that these leading stocks have? What do you think, Campos?
You're asking me how you find these?
Yeah, what are your thoughts on where do you go to look to find these companies? How do you start your search for these companies?
Joel, that all ties directly into my weekly and my daily routine, and it's just a matter of being a IBD subscriber and also a MarketSmith subscriber, using their tools to go in and look through different lists that they have, stock screeners that I've created, and sifting through tons and tons and tons of stocks and looking at the fundamentals and having a benchmark on what I am willing to kind of put on a watch list.
So what's your
piling
benchmark?
Stocks.
What's your benchmark? Interestingly enough,
if I'm focusing just on earnings, it's 20%.
Okay.
So I'll not saying I'll buy the stock, but it'll pique enough interest for me to do a little further investigation. However, with that being said, if I do see exceptional, like triple-digit sales, yet the earnings are just not there, at that point, I'll still consider it, especially if I understand the company a little bit. And IPO stocks, that's completely different, because a lot of IPO stocks might not have those earnings yet, but might have great sales.
Right. All right. So you basically start in IBD. So if you hear what Campos is saying, he's looking to find something tangible. The C in cancelim is tangible, where the N in cancelim is actually vague. If you really want to know the truth, I would say vague. It's not concrete.
It's hard to really truly quantify in numbers.
But if you join these, so if you're looking at the N in cancelim, which is really where you want to start on that company, you're going to join these with the C. O'Neill clearly is looking at the C first, and then then doing the investigation. It works out either way. Like, I'll give you a perfect example. Simply Foods. That's the name of the Quest bar company.
Yes.
Okay. When Campos brought it up to me, I was unaware. I thought it was the Atkins company, but I didn't realize 6 months ago they bought Quest bars. So this actually could be helpful for people. Once I went back and looked, then I started looking at their sales and earnings, and I was like, this is pretty cool. I'll give you another two examples. Earlier this year, I had invested in, pretty successfully in Neo and Celsius brands. And how I found those was actually, I was completely unaware of those companies. I just saw earnings and sales, and then I did a little bit of a deeper dive. So this, like I said, there's no chicken and egg here, I guess, or you can say it's which came first, the chicken or the egg. You know what I mean? I guess it's a vague debate. Is it the C or is it the new? And sometimes sometimes this is one of the most interesting things about the new and the C. You could find something that's new and it doesn't have the C yet because you're early. And this is where timing becomes a massive, massive topic. But ultimately, at some point, the earnings and sales are going to have to validate the end that you have found. What I'm saying is, if you're early in a trend, sometimes it's not validated and you have to wait for the sales and earnings to come through before that's validated. So getting back to what I was saying, what are the qualities that all these leading stocks have? It's large and accelerating quarterly earnings and sales. And now we're going to do a deeper dive into some of the past winners. And this that it should give you a very good gauge on what you're looking for. What are we looking for? We're looking for the big winners of the past. That's what the great thing about Cancelam and the system is that it gives you historical precedence for what to look for the next set of future leaders. Some of the current and past stocks that have displayed these type of current earnings and sales are Tesla, Zoom, Apple, Facebook, Google, Microsoft from the 80s and 90s, Walmart from the 70s to 2000s, McDonald's through the 60s and 80s, Cisco Systems, Dell Computer, BlackBerry, Home Depot from the 80s to 90s. Clearly, all companies we've heard about that are some of the largest companies in the world. And how do they go? How does a small company go from being a small company to a large company? It's got to have huge quarterly and earnings sales growth. I don't think that there's a stock or a large company out there that hadn't had its time where its earnings and sales were growing 20, 30, 40% for a certain period of time. Those are the breadcrumbs that you're looking for. Big earnings and sales. And I'll give you an example. Zoom, Tesla, Apple had triple digit earnings and sales, particularly Apple, probably for about a decade, had earnings and sales in the 75% and above, on a lot of time, triple digit earnings and sales, starting with the iPod, which Campos doesn't know about because he was too young for that, and the iPhone and all the other things after that. He hates it when I say that.
Yeah, because the iPod was my generation.
Here we go. Again, Tesla has had recently triple digit sales. Its earnings are starting to catch up now. Zoom last year had triple digit earnings and sales. So those companies had more of a shorter time frame where they had these huge earnings and sales growth. Whereas you have other companies that are more like the Home Depot, Walmart, McDonald's, that all had consistent earnings and sales growth at very high rates, which are still 20 to 50%, but they had it. And this is where you got to begin to look at these and not be so focused on triple digit sales for decades. Walmart was one of the craziest growth companies of all time. They grew, I think, like 30% for 3 decades in the 70s, 80s, and 90s. It was really unprecedented. It was like clockwork. Same thing with Home Depot and McDonald's, all very similar. So you're going to look for two tiers. You're going to look for your triple digit tier, and then there could be like that 20 and 30% company for many, many decades that has that type of growth.
Consistency.
Yes, consistency. What do you have to say about that, Campos?
Well, I think you summed that up perfectly. It's like there's the explosiveness of, and I think the explosiveness normally shows a huge drastic change in some sort of industry like a Zoom. Like the explosiveness in their earnings was a drastic, quick change to the industry and a new product that was being put out or just change in that area. Then you also have the consistency where it's more of like your Home Depot, where it's just, yes, it's a new, and they might not be having crazy like 1,000% increases, but they are just continually leading that space, continually executing properly, continuing to grow earnings, and that all of this, all it really is historically big institutions are looking for that earnings growth. And when they see that earnings growth, that's the type of companies that big institutions are going to start to invest their money in.
Right.
And
But
it's all based on history.
Let's leave out the institutions for this topic.
But no, that's a big.
But
that's the reasoning behind.
Right. But
the whole reason why
agreed.
that we were focused on this is because William J. O'Neill went out and said, our goal is to follow these institutions. What are these institutions doing? And
Right, but
then
that's not
by
core
looking
to the
through
stocks.
history, was able to say this is what they're doing,
Right, agreed.
and that's how we got to this point.
But that's the I. So we want to just really talk about the C, which is really getting deep into the sales and earnings of these companies. And really what we're looking for are the breadcrumbs. And like we said, we actually kind of said it earlier, which is really interesting. Do you find the sales and earnings growth through some of your stock screeners, or do you find the company like Campos found Simply Foods, and then you go backwards and then you look to see if that company validates itself with the earnings and growth, sales growth that it has. So that's really what we're looking for, are those attributes. And then again, to Campos's point, at some time the institutions are going to come and buy it, and they're going to begin to push the stock. But what you want to do is you want to find these trends as early as possible. That's why it's so important. And another stock that I didn't put in here, Netflix. Netflix was a great example. That was like I don't think there was a stock that was in plain sight for the whole entire world to see, that people could have taken advantage of it as much as Netflix in the early 2008, 2009, 2010, once they came onto streaming, and they were gaining millions and millions of subscribers, and it was just right there in plain sight. And it was a company that again had a decades long run, and that is Netflix might be the poster child of what we're looking for, because it took a while for companies to catch up. And like Campos was saying about the Walmarts, the Home Depots, and those type of stocks, they're showing consistency and they're out executing their competitors. Those type of companies are usually in an industry that there's already a competition, and they've just improved upon an already existing industry. Whereas a Zoom, a Netflix, a Facebook, those type of companies are creating something completely new, and that's where you get into the triple digit growth. Would you kind of agree with that statement?
Yeah, definitely.
Yeah. So would you agree with this statement too? Of the Cancelim
Well, if you're saying it, probably not.
Okay, well, we'll find out. Of the Cancelim acronym, this is the easiest letter to understand by doing the work, and just to understand it. It's just very simple to understand.
Yeah, absolutely.
Okay.
Because even if you're not looking at like the EPS rating on MarketSmith and on IBD, kind of quantifies everything that you're looking at under the C. Even if you don't have that rating, just by simply looking at the acceleration, the percentages, and it's something that you could very easily do on your own, where some of the other things are a little harder to really quantify.
And take time, like we talked about last week. Distribution days take time to understand and learn. The market takes time to understand and learn, and how that's correlated as well. So I agree with everything you just said. Where do you find these? You could find these companies anywhere, but on IBD, if you're looking for or just if you're looking for consistent earnings and sales, you could find them, like Campos just said, looking at the EPS rating, and that gives you a really good hint. When I first started my career, I was obsessed with going through every single stock that was an 80 and above composite EPS rating. I was like completely obsessed with that, to find the fastest growing companies in the world. So that's a place to start. So you can find it on IBD or MarketSmith. One last little variant to this topic is, and they've talked about this on IBD, the IBD podcast, some of the other IBD videos. One little change that's happened from probably the 80s and 90s and 2000s till now, and this probably has to do more with the type of companies that have become the growth companies. Sales growth is more important than earnings growth. Some companies have taken a little bit longer time to scale up. And if people see the sales growth and can extrapolate that for a longer period of time and understand that's going to be 4 or 5 years, and they can see where profitability is going to happen, it seems like investors are a little bit more forgiving on having a company lose money, but yet having explosive sales growth. Do you remember those discussions?
Wait, just people, or who?
Institutions. Correct. So that's something that you have to focus on, is really, I'd put a little bit more weight on the sales side. And if you could extrapolate that sales for many, many years versus the earnings, because the earnings at some point will come.
Mm-hmm.
What do you think?
And that's just something. Again, don't take that as a blanket thing. Well, all right, throw out the earnings and worry about the sales. Like there's certain type of companies. It's just how the environment's been lately, and the sales. If you don't have the earnings, like Steve said, it's got to project that there's going to be. Obviously, you can't predict the future, but it's got to show that the probability is sales are going to continue to increase for longer periods of time. And more often than not, I know me personally, I'm looking for then triple. If I don't have earnings, I want like triple digit sales.
Yeah,
Very, very close.
You want to be able to project that, because if you don't have earnings, you're basically giving away your product and you're never going to make money. So what's the point of that company?
Yeah.
It could be like two idiots.
Sales.
Wait, it could be two idiots making videos on YouTube for nothing.
Yeah. But because the sales is what's going to lead to the earnings. That's
correct.
That's really what it is. It's saying that the sales are so strong that even though the earnings aren't there, the sales are showing that earnings are on the horizons.
Correct. So that's the C in Cancelim. Very straightforward. You could find it on IBD. You could find it in your own course of your life. You're looking for high, EPS ratings. You're looking for high sales growth. You're looking for high quarterly earnings.
Let's say the bigger the better.
Yep, exactly. So a very straightforward topic, not too super complicated, pretty basic.
The one thing that I just wanted to just touch upon too, because I overlooked this. So when I used to look at charts, I would say, all right, they got they got a 90 EPS in the last quarter. Why is their EPS rating so low? Looking at the acceleration is very, very important, because if they have had 900, 800, 800, 900, all of a sudden then it drops down to 100%, 80%, 70%, 60%. Even though you still have very, very good earnings, you could see the earnings are decelerating. So acceleration is definitely something to keep an eye on. That's something that you want to pay attention to. So even if it's got good earnings last quarter, in context of recent quarters and the acceleration, it's something to really pay attention to.
Yep.
That's all I wanted to add.
Yep. All right. So C and N are very closely correlated. You want to pay attention to both. If you and one last thing about sales and earnings, it's better to find a company that has sales and earnings. But if you're finding something that has triple digit sales and you could sense that it's going to be like that for a decade or so, or just a long period, you're not going to get a decade of 100% growth, but for a longer period of time, then it's certainly something to investigate and look into investing. So this is one of again, all of the letters are important. But the C is going to be one of the main drivers of the fundamentals of a stock. And hence, then you're going to get institutions that are going to begin to invest in the stock once you get the C. And that's all I got.
Good to me. There you guys go. Email, Instagram, both of our Twitters, Discord channel in the description. If you'd like to join Discord, there's always a link. Click that. It'll take you to it, give you an invite. But yeah, that's it. We also have a ton of other videos that we're going to be continually going through Cancelim and just having a talk and a conversation around all the different letters, all the different aspects. So yeah, if you guys have questions, comment below. Other than that, Steve, what do you got?
Endure the pain of discipline.
Stay disciplined.